So, my top 5 investment mistakes. My first investment mistake was trading stocks instead of owning it. When I just started my way, I was all about buying low, selling high, taking out the profits, looking for some patterns. The problem with trading is that there are a lot of things depends on your luck, and the trading can be suitable as a source of income. But it's absolutely not right for building a long-term wealth. Some guy once said that the disadvantage of all the get-rich-quick schemes is that you have to do them very often. Here what you should do, instead of trading stocks, you should look at stock not at some financial instrument that gonna increase your money or make you rich. You should look at a stock like it's a little piece of a company, a little share of a company, and by buying a stock you become a business owner, a co-owner of a large company, and you have a right on its share of profits, on its share of company's growth that will affect your stock price. And that's the only way to set the right mentality for long-term investing in stocks. My second investment mistake was looking strictly at the numbers. I was analyzing different metrics, price-earning ratio, price-book ratio, looking at dividend increase, at financial statements, and I didn't have the complete picture because all this data, everything you can find online, are publicly available, and it's already reflected in the stock price. If some stocks are cheap and other stocks are expensive, it's just because people, all investors as a group, have an optimistic expectation from one company and pessimistic expectation of other. For example, oil stocks now trades at a very low price earning ratio, like 5 or 10 times, and that's because people expecting the decline in earnings, and basically a lot of that companies are already having already reporting the loss in the past quarter, in the quarter before past. And for example, tech stocks like Microsoft, like Amazon, like Tesla, they have a very high price earnings ratio because people in general, as a whole, are expecting that the earnings of these companies are gonna to grow very much in the future, and they are paying today for the profits, for the earnings they expected to receive in 2 years, and 5 years, and 10 years. To get a full picture here, you should look not only at the numbers, but try to understand how this business works, how this company operates, how it makes its money. And you should know it so well that you could explain it to a 4-year-old kid, because when you master some topic, you can describe it with a very, very simple words and decompose some complicated things into a much simpler. And my third investment mistake was once I was already understanding how different companies works, I wasn't taking right attention to the people. I wasn't investing in the people, because every company, it doesn't work automatically. Every company's success or failure very, very much depends on its leaders, very much depends on its top management and executives. And by not studying, by not examining the company's leaders, you are missing a very, very large reasons that can contribute to future of this company. And here I recommend you to watch as many interviews as you can find on YouTube, on other websites, to read some articles about the company's leaders, about its CEOs. And you should look for people who don't just work there for a salary, for an executive compensations and other benefits, or for some status. Instead, you should invest in people who are very passionate about what they are doing, who work towards some purpose, who have the same goals in life as their company, and people in whose achievement of their dreams you truly believe and to whom you could trust your money. And when I limited my stock positions only to the companies of a very purpose-driven people, very passionate people, I started having the most of my investment return after that period. Because that was the people who are dedicating all their time and energy to the company's success, to the ideas of the business. My first investment mistake was being too impatient. After reading several books on stock investments by Benjamin Graham, Jack Bogle, Peter Lynch, I wasn't anymore concerned that I'm losing my money when the market price of my stocks going down. I was considering it as some opportunity, as some sale where I can buy my stocks and buy new stocks of that companies with a large discount. And I was anticipating that when I saw a little price decline, I was loading the stocks a lot. I was taking out my credit card balance. I was trying to rebalance between different stocks, selling stocks that looked overpriced and buying stocks that declined in their price. But when I checked my results and compare it in Microsoft Excel, what would I get if I didn't change it my original positions, if I was adding to my positions on the days I was getting my salary, and I noticed that it was not that much difference, and because you actually can't predict the price movements, what you view as today's bottom, it can be today's peak, and vice versa. So the best way here is to invest regularly. Try to buy companies despite its short-term price movements. Try to think how much this share of a company will cost in 10 years. And when you view it in such a large time horizon, you aren't much concerned about how much it costs today comparing to yesterday or comparing to tomorrow. You just buy a stock and you know that it will cost much more in 10 years, and you like this company and you are buying it at the same price what market offers you today. And my fifth and the biggest my investment mistake was being too frugal. There were months when I was saving up to 75% of my income. I was very dedicated to the goal of building a net worth, of building my wealth. When I got this idea that $1 invested today, how much it will cost in 10 years, how much it will cost in 20 or 30 years, and how many opportunities you will get when you'll be among rich, and that will be a lot of possibilities for your self-realization that aren't available for a middle class. But for some time I understood that your security doesn't lie in your net worth. It doesn't lie in your ability to keep the money, because actually your security lies in your ability to produce, in your ability to give some value to the market, provide some value to the society in exchange of money, your ability to think, to solve problems, to create something. And actually some amount that you are deciding not to invest in stocks today, it can give you much better return if you invested in things you really enjoy, in things you really like. Because life is not just accumulating the money, accumulating the stocks, accumulating the other possessions. You should enjoy many beautiful experiences in life, and not just trying to become the richest guy in the symmetry. Because so many people, when they get old, they regret that they were saving too much, that they didn't have enough experiences, didn't invested enough time and their energy into relationship with other people. And no one yet regretted that they accumulated too little money in their life. Yes, there are people who don't like their financial situation when they are old, but actually experiences, they matter much more as the life comes, as the life passes. And you should find your balance and do not try to save too much. Just limit yourself to 10% of your paycheck. And if you want to learn more about investing, personal finances, subscribe to my channel, Walls of Babylon.